Hi, everybody. Thank you for joining us. Tricio's latest webinar, Navigating the Stock Market for Investors. And today I'm joined by John Calverley and James Chu, and we're going to be doing our best to give an overview of what we think are the underlying fundamentals of most of the stock markets. And we'll look at some of the technical charts and potential opportunities and risks that we spot in the major markets. So I'm going to hand over to John Calverley, Tricio's chief economist right now. Thank you, John.
Thanks, Gerry. So the agenda today really is to look at the stock markets. If you go to the next slide, Gerry. We're going to be focusing on particularly the medium and long-term view of the major markets. Obviously, we'll spend a lot of time on the US because that tends to dominate. But we'll also be looking at Japan, which is near all-time highs, and asking whether that will go further. We're going to be looking at China and emerging markets as well. A little bit different format to our usual webinars in that we'll have less on the fundamentals from me and more looking at the charts, but also discussing the fundamentals from Gerry, and maybe I'll chip in a bit as well. So just 2 or 3 charts on the fundamentals, just to remind us. This is showing the GDP in the 3 major regions, US, Eurozone, UK. And I mean, there's 2 things to point out here. One is how well the US has done since COVID. And that, of course, is reflected in the stock market over the last several years. But also, and I think you can see it at the end there, a bit of a switch in the last few months in that the US appears to be slowing down. Generally speaking, data is disappointed, and growth is probably still 1.5%, 2%, but it's well down from the 3% plus that we saw last year. And meanwhile, the UK and Europe, which were in recession last year, and really very weak growth for at least a year before that, are starting to pick up. So we're seeing a little bit of a switch that's been reflected already in currencies, and maybe it'll affect stock markets as well. Obviously, the key issue for a while has been inflation. We've been in this phase now for essentially 3.5 years, where everybody is focused on inflation and on monetary tightening and how quickly that will bring inflation down. And this is where we are. Core inflation, which is the key really, has come down a lot, but it's still running around 3.5% in these 3 countries. So that's too high. Central banks definitely want 2% as the target. There's some signs of stickiness, although it's a bit variable. I would say recent data for the US has been rather promising after a bit of stickiness earlier this year, whereas the Eurozone and the UK, we're seeing a little bit of stickiness just in the recent data. So there's still some concerns about that. But generally speaking, inflation is doing well. And I think what's interesting in a way about the markets is that we may well be transitioning into a new phase where inflation isn't the problem anymore. That's not the main focus. Keeping rates restrictive isn't the main focus. And the question then becomes, where will rates go? How much will they be reduced? And so on. So looking forward, the prospects are good, I think, for continuing growth, for inflation to hit the 2% targets. That applies to Japan coming up to 2% as well. And for lower rates, obviously Japan, slightly higher rates. So that, for the Western countries, that's the soft landing that we've been talking about for 2-3 years now. A lot of people talked about recession. A lot of people worried about inflation staying too high. So far, we are on track for this soft landing. However, there's obviously risks out there. One is that inflation isn't beaten, that actually we get stuck at around 3%. We've talked about this quite a bit, talked about it as the last mile, getting down from 3 or just over 3 to 2. We can still see wage growth is a bit too high, so there's still issues around that. That may be difficult, so that's one risk. That would keep interest rates high. In a worst case, that actually sees the Fed raise rates. That looks pretty unlikely at the moment, but it can't completely rule it out. Another risk is that rates stay too high for too long. Some of the weaker data out of the US, that's bringing forward the people who say US is slowing down, it will slow down too much, it'll go into recession. So that's another risk as well, kind of an overshoot. Another background thing which people are talking about and which we worry about a bit is on the fiscal side. You do have large deficits still in the US, UK, France, Japan. Could there be some kind of bond market revolt? In the US, we have President Trump, who's got big plans to cut taxes. But again, it could be that this will lead to deficits continuing high for a long time. That could lead to higher bond yields. So that's an issue. And then, as always, there's the geopolitics. I think in those terms, you have to look at what it might mean for oil prices. And if there was some kind of confrontation with China over Taiwan or over the South China Sea, what does that do to markets? So that was the sort of fundamentals, economic fundamentals. Let's just have a quick look at valuations before we go on to look at the individual performance and charts. So here's the cyclically adjusted price earnings ratio. It's looking at 10 years of earnings adjusted for inflation and looking at the current price. If you look at the red line, the US, it's pretty expensive, not as expensive as it was in 2021. But of course, interest rates were much lower then, bond yields as well. Also not as expensive as it was during the 1999-2000 bubble. But if you compare with all the other periods, really since the early 80s, relatively expensive. The EU, not so much, doesn't look particularly cheap, but it looks reasonable, especially given the stage of the cycle in Europe just picking up. And the UK, probably even more reasonable. But of course, we know that the UK market has a different mix to the US. So it's not surprising it's on a lower price earnings ratio. Nevertheless, we do think the UK is probably the cheaper of these three markets. So looking a little bit more detail at the US, the red line here is the S&P 500 forward price earnings ratio. So that's just based on expectations for earnings over the next year. What's the price? And again, it's a similar picture, if you can just eyeball the red line, to what I showed with the CAPE measures. It's the price earnings ratio, the forward price earnings ratio is around 21 times. It's pretty high compared with most of the last 20 odd years, but it is below where we were in 2021, and it is below where we were in the bubble in 2000. But within that, if you look at the pinkish line, that is the mega cap 8 companies. This is a chart I borrowed from Yardeni research. So it includes the so-called Magnificent Seven, the ones you're probably familiar with, and adds in Netflix as well. It only goes back to, I think, 2012 or so. Again, you can see it's jumped up recently. It's pretty expensive. It used to be not very far different to the rest of the market on average. If you go back to 2014, 15, 16, now there's a big gap opened up. And of course, that has been the story of the last several years. It was the story during COVID, more recently with the excitement about AI. This has happened again, and we've seen this big outperformance. If you look down there at the bottom, the blue and the green lines are the mid cap and small cap. If you eyeball that across the 25 years, you can see they still look relatively cheap. Those stocks have been popping a bit in the last few days, but still relatively cheap compared to the rest. So looking again at the difference between what was in effect the impact of the big stocks. This time around, this is the Yardeni chart, but this time we've got the S&P 500 in blue. So that's the same as we saw before. But the red line here now is the median forward price earnings ratio. So it's the 250th stock in effect. And you can see on that basis, there's a gap opened up. So again, this is just reminding us that the market has been driven very much by a few top stocks. One of the things we ask at this point is AI and is technology stocks, are they in a bubble of sorts? And I've done a lot of work on bubbles over the years, written a couple of books on them. And what I found looking at this is you can't just look at whether prices are rising fast. You can't just look at valuations. You've got to look at a whole range of things to judge a bubble. And it is still very much a subjective judgment. So I started to use this checklist to looking at any kind of bubble. And the more you've got checked as yes, the more risk that it is a bubble. So if you just run down them, looking in terms of the AI stocks in particular, obviously rapidly rising prices, yes. High expectations for price rises, yes, a lot of optimism. Overvaluation versus history, well, certainly high valuation versus history, I'll tick that yes. Is it irrational? AI, we think, is very important. When I look at it as an economist, I think AI is going to make a big difference over time. It's going to massively improve efficiency, productivity. I'm quite optimistic about that. Whether individual companies can capture that is another matter, so you can question that. Yes, there is an argument that it's not irrational, but you can discuss that. Are we several years into a business cycle? This one I struggle with a bit. We're sort of 3 years into the upswing since COVID, but you could argue we're sort of more than whatever it is, 16 years into 15, 16 years into an upswing since the global financial crisis. The point of this one is that if you have a situation where you're a long way from the last big recession, people get over-optimistic, over-exuberant, I think probably I could put a yes on this, frankly. Number 6, is there a new rationale for higher prices? I think there is. It is that a small number of companies are going to benefit enormously from AI because they have the right chips or because they have a lot of data. And the new paradigm here is that AI is going to be massive, and I think that's right. We are seeing new entrepreneurs drawn in, new investors. We are seeing obviously a lot of popular media interest. That's always a clear sign of a bubble. The next few, though, are macro indicators, and there it's pretty mixed. We're not seeing rapid credit growth. We're not really seeing new lenders and lending policies. We're not seeing a relaxed monetary policy. We do have a falling household savings rate. I'm not sure that has a lot to do with the strength of AI stocks. We do have a strong exchange rate for the US dollar, at least until the last week or so, but still strong. So overall, I would say there are signs of a bubble in the tech sector. It's not a general economic bubble for the whole economy, which is good news for the economy because even if tech stocks were to come down substantially, I don't think it's going to blow up the economy the same way that a housing bubble can. But nevertheless, I think there's enough yeses in this checklist to say, wait a minute, let's think about this. Let's at least take a careful view on this. Switching to the other markets again on the valuations. The left-hand chart here is the Japan cyclically adjusted price earnings ratio. If you go back far enough as we have here, you can see the bubble in the 1990. Also, valuations were very high in the early 2000s, but that's largely because the earnings were so depressed at that time after the lost decade of the 90s. You just look at the last 10, 15 years, we've come up, obviously, in the last couple of years, but still within that range and not wildly high. So we think the Japan market, despite the rises we've seen, particularly in local currency terms, is on reasonable valuations. And the right-hand chart, just really to highlight the gap that's opened up between India and China here. China's about 25% of the emerging market index, but it's down at 10 times. It does look pretty cheap. There are good reasons for it being cheap. We can go into that later if you want, but nevertheless, it is cheap. India looks very expensive. Probably good reasons why it's expensive too. I would argue that is rather expensive. And if I was looking for another bubble outside AI, I'd probably look at India.
Thank you, John. Now, following on from John's presentation of what's going on in terms of valuations and the economics, what stands out to me anyway is exactly what John was talking about, which is in terms of leadership in the market over the last 10 years, you would have to think that the US tech sector, as a proxy we can use, the NASDAQ 100, has done very, very well. And that's been the case this year as well so far. In terms of other markets, you can see that some of the emerging markets are doing better, then some of them are not doing as well. Noticeably, you can see that the Hang Seng as a proxy for China is up just below 6%, 5.68 earlier this week. But on a 10-year basis, it's still down the best part, 25%, which is, for a global investor, not something you really want to contemplate in terms of the returns of 10 years of hard work. And here we have a look at the US market, the S&P 500 in terms of sectors. And again, you can see what John was talking about in terms of tech leading the way. And here you have just both a choice. You have the technology sector, which year to date is up over 20%. But you also have things like communication sectors, which is up nearly 19.2 as of, I think it was Monday. And that includes a lot of the big tech names. So it is spread around. And as you know, Tesla is, I think, discretionary these days. So that's up over 7% as well. So it's one of those things where the market has, quote unquote, broad gains overall, but it is specialized in certain sectors. One of the key drivers that we're looking at in terms of what's going to be driving the stock markets higher this year, or potentially higher this year, would be falling bond yields. This is a chart of the US 10-year bond yield going back to the, I think, late 80s. And as you can see, we didn't break above the 5.3 area, which was pretty important for us on the way up. We were thinking once we started getting above 1%, 1.5%, that yes, bond yields would go a lot higher. We were thinking 5%, maybe 5.3%, some risk of 6%, but we didn't really see it staying there for very long. We were hoping that we see months, and John can correct me on this one, but I still think we're looking for the Fed to probably cut rates at least one time this year, even though in the latest Trump interview with Bloomberg, he was suggesting that the Fed shouldn't cut rates before the election. And I think the Fed's probably going to ignore that. If they feel that they have room and cause to cut rates, they probably will, regardless of the election. So we're looking for bond yields to drift lower, break below 4, go down to 3.8, which was where they based out last December, and continue to go lower down towards 3%. Now, in the back of that, we expect the yield curve or the coupon curve, and that's a little red line here in the bottom chart. We expect that to start moving back into positive territory. And that's either a good sign or a bad sign, depending where you are in the economic cycle. Short-term yields, like the 2-year note, which track the Fed funds rate over the next few years, should be able to come down if inflation comes under control and the Fed manages to lower rates where we think they could go down. Let's say right now they're at 5.25, go down to 4.5%, 4%, 3.5%, 3%, if everything works out in their favor. Next chart is S&P 500. Now these charts are all, I believe, monthly charts, and I believe that they are basically semi-log on the right-hand column. So that means that we're adjusting for the fact that prices get distorted as they move higher. So by looking at semi-logs, we're looking at percentage gains. And this one, it's one we've shown many times over the last few years, and it's a very boring chart. As John pointed out, look, it's a great chart because it keeps you focused on the 18-month, 3-year sort of view that we're still in a broad bull channel. But there's a serious amount of downside risk. I mean, right now we're trading at the best part of 5,500, 5,600, and yet the bottom of the channel is around 4,000. If you start doing percentages, that's a year's worth of losses and then some before you actually start testing the bull trend, which is why we look at all sorts of things. This is just one of the long-term charts that we look at to basically keep us guided. And we're saying, yes, we're still in this channel. Yes, we have upside potential to just above 6,000 now before we start testing the top of the channel. And yes, when we start testing the top of the channel, we will start thinking, okay, this is getting a bit frothy. Let's take a look at our short-term support levels, which is what we do for our clients on our weekly, monthly publications. And we also do that in our blogs and focus reports. So if we see things that are looking like a big corrections happening, we'll let our clients know. At the moment, though, it's looking like it's still got some nice tailwinds. And these are our forecasts, where, like I said, we're looking for it to bump it to 6,000. And when you're doing technical extensions, you're actually looking for around 6,800 to 7,000, which again would put us above the top of the channel and into the frothy area. Now, what about tech? Well, the NASDAQ 100, now here we're looking for gains on a simple extension well above 25,000. So that's giving us some serious upside from where we are now, if things work out. But again, here's a warning sign. Unless this happens like 6 to 12 months from now, that's going to be putting us on the top of the channel, which means we'll be getting to frothy territory again. And that'll be worth thinking about a significant pullback once we get up there. Now, Russell 2000, as John pointed out, the small and medium cap shares are still showing some pretty decent value. There's a reason for this. They haven't gone up in a while. So it's one of those things when we look at this, we say, yes, we're positive. Yes, we remain optimistic. And the last few days have given us a nice little shot in the arm. And we expect that to continue. Hopefully, a move well above the 2,500 area down towards 3,000 and hopefully higher in time. 3,500 is our next big target. So it's one of those things where, yes, we're optimistic in the sector. We've been disappointed for some time, but hopefully we're starting to get some traction now. Now, the FTSE 100, this is one of those things where, and you can see that we broke above 8,000, but we haven't really motored away yet. We're still optimistic, though, and we're looking for significant long-term gains here. Now, the headwind here, of course, is going to be sterling. If cable stays strong, a lot of people are going to be saying, well, I'd rather not be in the FTSE 100 if cable's strong. That's sterling against the dollar, because so many of the bigger shares in the index have earnings in dollars. And if sterling is going up, you get all sorts of problems in terms of your earnings coming back home. However, we think that investors will be more than happy to take that risk. So we're pretty happy being bullish here and maintaining our optimism over the UK shares. Now, in terms of the small cap sector, the FTSE 250 captures a lot of the medium and small caps that we look at in terms of liquid markets. And it's one of those things where we're very optimistic here. And again, we've been very disappointed before, but now we think we've got the nice little backdrop for this. So one, you've got sterling in your favor if it's strong, if this pound remains strong for these companies. For the most part, that's the way the market seems to look at it anyway. And we're looking for decent gains that should take us to the top of the channel, which again would be significant outperformance compared to what we've seen lately. Now let's take a look at Europe. Now here we are looking at the 50 large shares, Euro Stocks 50. We've done very well recently. and we expect it to continue. Now, I know we have wobbles, and there could be some further wobbles, right? We've got the war in Ukraine. We've got all sorts of government policies potentially grinding to a halt in France. But markets usually take those things in stride. As long as things don't get too extreme, then we would expect investors to stick around for the ride. How good could it get? We're doing a simple channel extension here, and we're looking for gains to new highs, well above the 6,500 area. So when we're looking at the European stocks in terms of the top 50, we still see positive signals. Now, we're going to look at one European index, and that's the German DAX. And why? Because it's done so well lately. It's one of those things where you kind of miss the fact that it was grinding higher over and over again over the last few months. And it's been a pretty good story considering the backdrop of war in Ukraine, China wobbles in terms of trying to get their export engine continuing to motor along despite the slowdown in China. So it's one of those things where you look at this and go, huh, you're doing pretty well considering all the headwinds that are facing you. Now with ECB in rate cut mode, hopefully that helps as well. So it's one of those things where we look at the DAX and we're saying, yeah, there's some serious upside potential there. Now, in terms of the final big market, we're looking at the topics. This is the Japanese index that we tend to favor, and it's one that just recently made new all-time highs. Now, let me put that in context. I spent a lot of my youth talking to fund managers, and they would very often say the Japanese market would never get back to the 1989 highs. It's one of those things where you could spend a career from the mid-90s throughout maybe to 2010, 2012, and still think you're in the middle of a range. But we started breaking out of it right around just in the aftermath of COVID. It is up a lot, but it could actually go up a lot more. So hopefully we'll see some upside progress continue here. Now let's take a look at emerging markets. Now this is one of those things where we have a lot of experience in terms of trying to look at emerging markets from both risk and reward opportunities. The key things for us is what is an emerging market? I usually classify it as liquidity, and then you have to start getting into how much, coverage there is of the market and things like that. So in some ways, it doesn't make sense that the MSCI Emerging Market Index has things like South Korea, Taiwan in it, because those are markets that are relatively liquid, and they are what most people consider quite developed in terms of the big shares that are there. They're, high tech shares for the most part. And you also have China. China used to be over 30%. Now it's down, like John said, to around 25% plus. And it's one of those things where when you look at the MSCI Emerging Market Index, you've really got to be aware of what you're buying into. You're buying into something that, for the most part, has a heavy leaning towards tech, China sort of shares, and that can give you easy 40% plus. So it's one of those things where we look at it and we go, yes, there's upside potential here, but, right? We're positive. But let's take a look at China. Now, up until recently, we were actually underweight in our China allocations that we do every month. So every month we look at all the markets and we say, where would we be putting most of our assets in a balanced portfolio? And China, for a long time, has been underweight for a lot of reasons John can go into if you would like. But we've covered this previously. Basically, dead loads, growth under pressure, and there's not a heck of it's going to be a grind to get out of it. But it's not a screaming, buy it because it's going back to the moon sort of idea. We see that we've had the negative phase of growth and inability to deal with the debt crisis in a meaningful manner. Now we're going to muddle our way out of it, but shares should do better than they have in the past, which is why we went from underweight to neutral. So yes, we're optimistic. No, we don't think it's going to happen in a heartbeat. How about Latin America? Now this is different. And for us, the reason we look at this is, remember, currency matters. So these indices, which are tracked by a lot of fund managers and ETFs, are basically dollar-based. So it's one of those things where if the currency is getting whacked, then the index won't do well. And we recently had some big moves in Mexico and Brazil. So it's one of those things where it's been under pressure, but we're actually relatively optimistic here. We think that the dollar is going to weaken versus some of these currencies, or at least not surge as much as it has recently. So here we're looking for this part of the emerging market universe to do pretty well. And John, that's it for us. Do you have any questions on anything I've said, John?
Lots of general questions.
I'm going to bring up the one that we haven't talked about, which is geopolitics, specifically the US election. Now, I'm going to go back, if that's okay with you, John, all the way back to the US yield chart, 10-year bond. And I'm going to ask you, what are the risks of Biden remaining in office for another 4 years versus the risks of Trump coming in for the bond market?
Yeah, I mean, one of the problems is I'm not optimistic about either of them doing anything much about the budget deficit. We're looking at the US budget deficit around 6% of GDP, which, given that we're close to full employment at around 4%, you shouldn't be there. I mean, ideally, you should be less than 3% on the budget deficit. Really, ideally, you'd be in balance or surplus at this stage of the economic cycle. So, I mean, Biden, of course, has done a lot of spending, and he hasn't really raised taxes. Trump would like to probably cut taxes further. Obviously, the tax cuts he put in place back in 2018 are supposed to expire at the end of next year. And when you look at the forecasts from the CBO and others, they make that assumption because that is the law. But in fact, those tax cuts will expire. So when they make projections for long-term budgets and debts, they're assuming those tax cuts will expire. But nobody thinks they actually will. Even if Biden was to win, it's unlikely that they would completely expire. And if Trump wins, you can be sure he will want to make sure that those tax cuts remain. Now, a lot's going to depend on who wins the House and the Senate, both of which are close this year. So we'll have to see there. If it's a Republican sweep, then, well, I would worry that the tax cutting will be too great, if you like, and that will drive the budget deficit. If Biden wins and also controls enough of Congress, then the risk is the other way, that the spending is high, and that keeps the budget deficit high. Either way, this could be a problem for bond markets. Now, this is not a crisis. This would just mean that we would see bond yields a little bit higher than they otherwise would be, and the yield curve a little bit steeper than it otherwise would be.
What do you think stock markets would be able to weather it?
Well, I think there's a bit of a mystery why the stock market's done so well in the last few years. I mean, it was up and down, obviously, in 2021, 22, and then up again in 23. But fundamentally, we've gone from a zero rate regime to bond yields around 4 or more, and the short rate at 5, and yet the stock market is up. So the stock market has certainly weathered interest rates. Now, maybe because in a way, for people old enough like me, we've only gone back to normal. 5% interest rates, that was considered pretty normal back in the late 80s, 90s, early 2000s. And if you look at a chart for bond yields going back to the early 2000s, we just come back to a normal range, really, 4 to 5%.
Yes.
So maybe that's why, maybe that's why, yeah, you can see it on there. Maybe that's why the stock market is reasonably quiescent. But I think fundamentally the reason the stock market is doing okay is because the economy's been doing okay, and profitability has been good and continues to be good. We're looking at second quarter earnings growth coming out in the US over the next few weeks, and yeah, looking pretty good so far.
Now, one of the things that's fascinating to me is your call on technology has been spot on for the last couple of years, where you've been looking for, some sort of innovation to push things higher. And this is at the back end of 2020. We were just coming out of COVID, or in the middle of COVID, if you will. And you were actually quite optimistic about innovations. And I was thinking, okay, nice to hope, but it's not a certainty by any means. But it has become something that the markets have latched onto. And also your observation that when you were looking at the valuations, that the US market has pulled away from a lot of other markets ever since 2000, arguably 15, 16. You could maybe look at it a little bit earlier than that, but that's generally when you see the tech innovation really pull through. And I'm looking at the NASDAQ 100 chart again, and you can see it here, where we had the dot-com bubble, we had the implosion, we had the global financial crisis, we meandered back up, and we've basically just motored higher, motored higher, motored higher. Even COVID, we came down, but we didn't break below the 5-year moving average. We just kept on climbing from there. I would love to say, because technical analysts are great for saying the trend is your friend, but we spend 90% of our time looking for tops and bottoms, right? We're always looking for the reversal, because that's how, quote unquote, you get excitement out of the market, you make your name, people love you, all that sort of stuff. Saying the trend is up, what are you going to do? Doesn't really do you much. It's like, okay, thanks. But that's been the name of the game. And investors who have stayed the course have earned the benefits of this. And some people have made names for themselves in a market by being invested in Microsoft from the mid-90s. or even in the last 10 years, 15 years, if you own Microsoft, which is by no means a bubbly, one trick pony sort of share, you've done pretty well in terms of what the share has delivered. So when I look at this chart, I go, yes, it's up. Yes, it's up a lot, but we are still stuck in the middle of a channel and it's still rising as far as I can tell. So John, on your bubble chart, you were nice enough to go to the table and work it through. When do we get worried here? When we took off a few more of those columns and the bubbles, or?
Well, I think we're ticking off most of the lines that relate to the market itself. We're not seeing the macro numbers, but I don't think we necessarily will because we didn't see all of those anyway back in 1999, 2000. If we did see those as well, then yeah, that would add to the feeling. I'm looking at this and thinking, well, this does look like a bit of a bubble to me. That the companies like Nvidia that produce the chips, their earnings, of course, are going gangbusters. They've had fantastic earnings results. So the price
You
earnings
can't
ratio
say it's
looks.
it's it's all smoke and mirrors, right? I mean,
No,
unless they're
and that's the
doing great.
case. Yeah, absolutely. Their earnings are great, and the earnings of the other companies have done very well as well. Looking at a longer period, I mean, Microsoft earnings have justified where the stock has gone to a very large extent. Although, as I said, the price earnings ratio has gone up compared to where it used to be.
Right.
But I mean, one of the main things about bubbles is that essentially what happens when you talk about a bubble is you're saying we've departed from what would make sense in terms of valuations for the long term. Trouble is, once you do that, once you depart from sensible valuations, there's no particular anchor. You can just go much, much higher before you fall back. So you probably need some kind of trigger to push things back, and I can't see what that would be. And it would certainly wouldn't suggest that people trade based on this for short-term trade. I think if you're a longer-term investor, you have to look at it and say, well, how much sense does this make? If it doesn't make sense, maybe I should be thinking about reducing weightings. At the minimum, I think this could suggest that you want to be rebalancing. Everybody should rebalance anyway, but maybe you should rebalance a bit more often if you're concerned about a bubble, because that the thing is moving so fast that maybe once a year or twice a year isn't enough. But you may also want to think about, do I want to take the risk on this? Do I want to be potentially exposed here if there's easily a 20, 30 or more % correction possible?
So by rebalancing, you mean quite specifically, let's say you have 100,000 pounds in your portfolio, you allocate, let's say, 30,000 pounds of it to US large cap equities, for instance, and it goes up a lot. So all of a sudden you have a 120,000 pound portfolio, and your US large cap allocation is now, let's say, 50%, which is above what you wanted. So you're saying take some of that money, excess allocation, and sprinkle it around the other ones, more bonds, UK
Yeah,
shares, whatever, just to make sure
yeah.
that you're back to that 30% allocation you wanted.
Yeah. And I think longer term investors usually do that periodically, sometimes once a year, sometimes twice, sometimes more often.
Yeah.
And I think that that makes a lot of sense. Of course, if the market keeps on trending up, and as you say, that we do tend to get trending markets, and that's certainly what the charts suggest. But so you will be giving up some gains there, but I think you'll be in a better position, especially if and when when the correction comes.
Yeah, it's one of those things where sometimes you have to buy things even if they're not going up. So, we've argued that value shares should make up part of your portfolio, even though momentum hasn't beaten them up the last few years. It's just one of those things that it's gonna be there in your portfolio when you need it, if you know what I mean.
Yeah. Well, it's also looking at China. You talked about China earlier. You're on a 10 times price earnings ratio, and there are good reasons for that. I think the economy is not doing very well at the moment in the short term. There's big structural issues. Property sector is still in decline, major decline. I think the economic model in China is failing, and they haven't really figured out a new model. This year, quite a bit of the growth they've been seeing has been coming from exports, but that isn't obviously very popular with the US, particularly with Trump. That may not be anything they can sustain. But they've got a real problem there. But when you have that level of valuations and looking at a long-term view, one day, sooner or later, that will likely turn up. Now, could be a long way away still, but there's certainly a case for saying, it's worth thinking about it. A lot of investors are not going to invest in China at all, and that's fine. They see China as problems from governance point of view, problems from the geopolitical risk point of view. But if you are interested in China, I think, or are willing to invest in China in principle, then I think you have to look at that valuation, particularly compared with the US or compared with India, and say, okay, this looks cheap.
Now, John, this is where I like looking at charts. And you can see my cursor. I'm looking at the Trump years, let's say 2016 through 2020. And Chinese shares, yeah, they were lumpy. They went back and forth, but they didn't underperform significantly, if you know what I mean. They did okay, right? Then this is obviously the COVID drop that we saw from 2020. Or you could call it the Biden aggression, if you will, because Biden wasn't exactly a softy on China either. And that's one of the things that we identified early on was saying, look, Biden's not going to be any nicer on China than Trump was because he's got no political benefit from doing that. So it's one of those things where if Trump gets in, I think the narrative is going to be, oh, you want to avoid Chinese shares. But history shows or seems to show that the investors will look through that if there's actually some progress within China that you can actually get encouraged about.
Yeah, I mean, I would. You're right. I mean, a lot of what you said is absolutely right. The Biden basically carried on with all the controls on China and has actually increased the specific measures against China on the tech side. But that peak you see back there, what is it, 2021, and then the big decline since then. I think that has mostly to do with the property sector collapse in China.
Yes, yeah.
They put in place these measures to limit the debt ratios of the property companies, and in order to meet that, well, they struggled basically. They couldn't do it, and the whole thing is basically imploded. So the amount of new floor space started at the moment is about 60% below where it was 5 years ago in 2019, which was kind of a peak level for the or peak period for the property market. So this is huge. You get a 60% decline. I mean, that's similar to what happened in the US in 2007-8. And in the US back then, the housing sector was probably accounting for 7 or 8% of the economy when you added it all together. In China, it was more like 25% of the economy. So,
Right.
and that's the construction itself. That's the cement, the glass, steel, all the rest of it. So that's been a huge hit. And, it's still not turning around. And it's very difficult for the government to turn it around because they already have a large budget deficit. They already have a large debt. They're having their plenum meeting right now, as we speak, 4-day meeting, and they'll probably come up with some measures. I'd be surprised if they come up with anything very major. And partly because I don't think the government is very much focused on really turning the economy around. They're just trying to keep it going while keeping control of the whole political situation.
And that's something you've been talking about for years, which is basically it's not just the central government, it's local governments and local government projects and tax receipts that are under pressure.
Yeah, absolutely. And it's difficult to assess these things because the Wall Street Journal highlighted one particular province which is in dire straits, and there are others like that. There are other parts of the country which are not in such difficulties, and it's quite difficult to get a handle on what it means across the country as a whole because it's such a big country and there's such big variation. But overall, I would recommend anybody to look at the IMF reports on this, on China, because they actually make pretty sober reading. When you add in all the government debts all together, you're looking at about 120% of GDP, even though the central government debt is much lower. And what's more, the numbers from the IMF suggest this is rising fast. It's going to continue to rise on current policy. So this is unsustainable, and they have really serious problems. So I'm not particularly optimistic on China as an economy. I just look at the valuations and I say, well, maybe it's already in there, and so it's worth thinking about.
That's great, John. So we're running out of time. So I'm going to say thank you to everybody who joined us on the webinar, and we hope you found it useful and informative. If you have any questions, I think one of our last slides usually has our info. There we are. And please feel free to contact us on tricio-advisors.com, info@tricio-advisors.com. if you would like to subscribe to our publications or just follow us on LinkedIn and or keep track of our blogs and podcasts on our website. And John, thank you very much for joining me on this. I hope you found it fun. And thank you, everybody, for joining us. And James, thanks for setting up a lot of the slides and working with us on our ideas. And I think I can honestly say we're cautiously optimistic. How's that, John? Or is that too reserved?
think I think we're cautiously optimistic on most of the markets. Yeah, I mean,
Yeah.
most of them have done pretty well, and some of them have done especially well. But when you look at the stage of the economic cycle, which seems to be turning up, except in the US where it's calming down, that looks okay. That looks good.
And one thing that John and I talked about before the webinar, and I guess we should probably leave some words of wisdom, if they are wisdom, is as far as the US election is concerned, I'm taking the view that it's going to be too close to call still. It's going to be who turns out to vote in November. It seems anyway. John, I take it you probably agree with that, or?
I totally agree. Yes, it's still 3.5 months away. The assassination attempt is going to fade as an issue, I think. We still don't know whether Biden actually is going to be standing. He might still back down. We don't know, whether Vance is going to help or hinder Trump over time. And the other thing, as I mentioned earlier, it will matter who gets the Senate and the House as well.
Correct. Yeah, very important. Okay. Thank you, everybody.
Yeah, thanks, Gerry.
Take care.